Right, so let's start here. The borrower's right to prepay. Now, this is something that we want to get right up front, right? Whenever we're making a prepayment, we want to make sure that the lender is notified. When we sign those documents, there's a clause in there that states what you see on the screen. And this is not exactly what you'll see, but it is something similar. It says there, I have the right to make payments of principal at any time before they are due. A payment of principal only is known as a prepayment. Now, whenever we make prepayments, we want to reach out to the lender, to the bank, let them know exactly what we're doing. We want to notify them, either in writing, over the phone, or these days you can even do it online. All right, so we want to get this right up front before we proceed. Now, if we go to brettwhistle.net, that's brettwhistle.net, it will give us an amortization calculator. Now, this is the tool I'll be using to teach how do principal payments work on a mortgage. Now, if we look here, we can see I'll be using the example of a $400,000 mortgage at an 8% interest rate. If you should put in all your information here and hit that little checkbox, hit calculate, it will give you a summary. Then it will give you payments from payment number 1 right up to 360 payments, which equals 30 years. So we're actually borrowing $400,000 at an interest rate of 8%, as you can see there. The total amount of interest that we'll have to pay for this loan is $656,000. That is over $656,000 we'll have to pay in interest to borrow $400,000. Now, the total amount of money that we'll have to give to the bank over 30 years will be over $1 million we'll have to give to the bank. That is the interest payment here, along with the principal payment. It adds up to over $1 million. Now, I said 8%, that's the interest rate, but the interest cost is actually it's over 164%, which is very, very important. It is not 8%, it is over 164%. Whenever we see interest rate of 8%, understand that is actually over 164% that you will actually pay over the life of the loan. We're going to start with this example, right? So let's take a look. So let's say we make our first payment on line number 1. All right, I want you to follow closely. We make our first payment on line number 1. And our first payment would be just over $2,900, as you see here. All right, we make that payment on line number 1. Look at how much it's going to interest. You see, we have over $2,600 that is going to interest. But then look at how much it's going to principal. Just a small amount is going to principal. All right. And so we make that first payment on line number 1. Right? We're going to make this first payment on line number 1. But we could look at month number 2, right? We could look at month number 2, and we can see that we have another payment here. And we could look at the principal payment, which is $270.18. So if we decide that we do not want to wait until month number 2, we don't want to wait, and we want to prepay this amount on month number 1 along with our regular payment, if we should do that, the question is, what will happen on this amortization schedule? What will happen? Well, this is what happens. If we take this $270.18 and prepay this amount on month one along with a regular payment, right, we will be able to skip line number 2, be able to skip line number 2 payment or month 2 payment, and our next payment would be on month number 3. Right? This is what happens when we prepay the principal. Now I want you to understand what just happened. In prepaying this amount, that $270, in prepaying this amount of principal on line 1, along with a regular payment, right, we were able to pay down to line 2 in just 1 month, right? And it only cost us over $2,600 to do it. Just over $2,600 it cost us to do it. Now, why am I so happy with this? Well, if we were following the bank schedule, right, and making our regular payments every month, look at this, right? You make a regular payment on month 1, a regular payment on month 2, right? Look at this. Every time we make a regular payment, look at how much interest the bank is getting. It's costing us $2,600 every time. Both times it costs us $2,600 to make when we make our regular payments, right? Now when we add this all up, right, it all adds up to over $5,000 to get down to line 2, right? The bank wants to charge us over $5,000 to get down to line 2, right, if we should follow the schedule the bank has for us. But as we can see earlier, we were able to pay down to line 2 in just 1 month, but it only cost us $2,600 instead of $5,000 that the bank is looking for. You see, by following the bank schedule, right, is very, very expensive. And as we go on with these examples, you're going to see how much money in interest. I mean, it's a lot. It's a significant amount of money in interest that most people pay because they don't know how an amortization schedule works when we prepay to principal, right? So let's look at the interest savings. Let's look at the interest savings. Now, when we prepay that $270.18, when we prepay that to principal, we were actually able to save $2,600 in interest. That is how much money we were able to save. Isn't this amazing? This small amount of money, this $270.18, we were able to prepay that money to principal along with a regular payment and save $2,600 in interest. Isn't that amazing? Now, if you're thinking, what if I only have a small amount of money that I want to prepay? Could I save any kind of money on interest? The answer is yes, you can save money on interest. Let's take a look. As you saw earlier in the example, we were able to prepay $270.18 and we were able to save over $2,600, right? But what if I only had half of that, which is $135, right? How much money could I save on interest if I prepay? Well, look at this. You're able to save over $1,300 in interest. What if I only had half of that, which is $67, which is half of that $135? How much could I save on interest? Well, you can save $666 in interest. Right? That is amazing savings. Right? What if I only had $33? Look at that. You can still save over $300 in interest. If you were thinking, what if I only had $16? Well, you can save $166. What about $8? $83 you can save. If you prepay that $8 to principal, you can save $83. What if you had half of that, which is only $4? Well, you can save $41. What is about 2, which is half of the 4? You can save $20 in interest you will never have to pay. What if I only had $1? Could I save money on interest if I only had $1? Well, the answer is yes. You can be able to save $10 in interest, right? And as you go on, you can see that even if you have 1 cent, even if you had 1 cent, look at that, we can still save 9 cents in interest. So as you can see, you don't need a lot of money to prepay to save in interest. Any amount of money that you have, you can save in interest. Amazing, amazing. All right, so let's look at another example. So let's say we're going to make our first payment of $2,900, right? We're going to make our first payment on line number 1, right? And we look at line number 2, and we see we have a principal payment of $270. And then we look at line number 3, we see we have a payment of $271. And then we look at line 4, we have another payment of $273. What if we don't want to wait until month 2, month 3, and month 4? What if we don't want to wait over those 3 months? And we want to prepay those 3 principal payments on month number 1, along with a regular payment. The question is, what will happen if we do this on this amortization schedule? Well, this is what happens. By prepaying month 4, month 3, and month 2 principal payment on month 1, along with a regular payment, we're actually able to skip month 2, month 3, and month 4 payments. And our next principal payment, or our next regular payment, will be on month number 5. On month number 5 will be our next regular payment. You see, let's understand what just happened here. By prepaying month 2, month 3, and month 4 principal payment, right? That is these 3 payments here, right? By prepaying these 3 payments to month 1, along with a regular payment, we were able to pay down this loan to month 4 in just 1 month. In just 1 month, we were able to pay down to month 4. And it only cost us, look at this, $2,600 to do it. This is how much money it cost us. Now, this is amazing, and you're going to see why. Because if we were doing it the bank's way, if we were doing it the bank, we are following the bank schedule, right? You would see that to get to line 4, it would actually cost us, look at this, over $10,000 it would cost us to get to line 4. This is how much it will cost us in interest. You see, every time we make our monthly payment, line 1, line 2, line 3, line 4, every time we make those payments, look at this, we charge interest, $2,600, $2,600, $2,600, $2,600, right? When we add it all up, it adds up to over $10,000 in interest. Over $10,000 in interest we will have to pay just to get down to line number 4. But when we prepay to principal, as you see, when we prepay those 3 payments to principal, month 2, 3, and 4, look at that, it only cost us $2,600 to get to line 4 instead of over $10,000 that the bank would like us to follow, That is a lot of money, right? And again, I tell you, a lot of people, this is what they do because they don't know this is the way that this amortization schedule, this is the way that it works, right? So this is let's look now at the interest savings. Let's look at the interest savings. So in prepaying this $270 and then 271, and then this 273. In prepaying these three payments on line 1, along with a regular payment, we want to know how much interest were we able to save in doing this. Well, this is the amount of interest we were able to save. Right? This is the interest savings on line 2, $2,600. On line 3, $2,600. On line 4, $2,600. Now that is a total of $7,998.22. Right? That is close to $8,000 we were able to save in interest. Interest that we will never have to pay. Interest that were canceled. This is the amount of interest that we were able to save when we prepay the principal. All right. So let's look at another example. Now let's say we make our first payment of $2,900, right? We make our first payment of $2,900 on month 1, right here, right? And then we look at the amortization schedule from month 2 right down to month 12. We're looking at all these principal payments, and we decided, you know what? I don't want to wait until for 11 months of principal payments. I don't want to wait to do this. I would like to do it on month 1, right? When I make my first payment. So if we should take all the principal payments from month 2 right up to month 12, if we should add up all these principal payments, right? And we prepay this amount on month number 1, along with our regular payments. The question is, what will happen? What will happen on this amortization schedule? Well, this is what happens. You can see here, when we prepay the principal payments from month 2 right down to month 12, right? If we prepay this amount in month 1 along with our regular payment, we're actually able to skip month 2, month 3, month 4, 5, 6, 7, 8, 9, 10, 11, 12 payments we're able to skip, and our next regular monthly payment would be on line number 13, or month 13 would be our next payment. Now, this is interesting. So this is what just happened. By taking these principal payments from line 2 all the way to line 12, when you add it all up, right, and we prepay this amount on line 1 or month 1 along with a regular payment, we were able to pay down to line 12 in just 1 month. And it only cost us, look at this, over $2,600 it cost us just to get down to here. This is amazing stuff. Now, if we were doing it the bank's way, if we were doing it the bank's way, if we were doing it that way and following their schedule, look at how much it will cost us, right? Making our regular payments, right? Every month we're making our regular payments for a whole year. Every time we make our regular payment, it costs us $2,600. Right? Look at that. It just keeps going on and on. Right down to month 12. When we add it all up, this is the amount of interest that we will pay over 12 months. Just imagine that. This is what most people pay. And you can see over 90% of the people that I know that have a mortgage, this is how much they pay in interest. Because again, they don't know, right? And by following the bank schedule, it is very, very expensive, as you can see. Very expensive. This is what the bank wants you to do. But as you can see earlier, when we prepay the principal, when we prepay the principal payments from month 2 the month 12, we prepay that early in month 1 along with a regular payment. Look at how much it cost us. Only $2,600 instead of $31,000 in interest. Isn't that crazy? Right? So this is amazing. Now let's look at the interest savings. Let's look at how much money we're actually saving in interest when we do this. Right? By prepaying these principal payments for month 2 right down to month 12. When we prepay this amount, give it early along on month 1 along with a regular payment, look at this, we're able to save all this money in interest. 2,600, 2,600, 2,600, 2,600, 26, and it goes all the way down to month 12. And the total amount of money that you will actually be able to save is $29,212.59. Look at that, over $29,000 you'll be able to save in the first year. In the first year, right? You'll be able to save. Isn't that crazy? That's a lot of savings. To prepay this, when we add up all these amount of money here, when we prepay this amount, isn't that amazing? So again, we're looking at how do principal payment work, and we're understanding how it works on this amortization schedule.